Welcome back. In this part 2, we'll dive deeper into evaluating the company's self-assessment. Please like my video. Let's get started.
In the past, corporations provided raw financial data to the state, and the government calculated the final tax bill. Today, that regulatory logic is reversed. Trillions of dollars move through modern corporate entities every day, generating billions of distinct taxable events across multiple business units and jurisdictions. To manage this volume, tax authorities rely on a specific regulatory framework, the Self-Assessment System, or SAS. Under SAS, the company serves as the primary authority. It is responsible for determining its own taxable income, calculating the exact tax due, and filing the returns directly with the state. This structure moves the legal burden of proof away from the government. The state no longer has to prove how much a business owes. Instead, the enterprise must be prepared to prove its own calculations are accurate. This mechanism is now the standard for corporate income tax filings across nearly all modern global jurisdictions. SaaS functions as a continuous compliance framework, establishing a significant layer of financial risk that must be managed alongside daily operations. Operating within this system requires navigating 5 strict, non-negotiable architectural rules. The first rule is self-calculation. Companies must independently extract and verify their own income, expenses, and deductions without receiving prior assessments from tax authorities. The second rule is tax return filing. These formal submissions are governed by inflexible statutory deadlines. The third rule is payment of tax. Remittance is immediate, often requiring advance installments based on internal estimates. Operational autonomy pairs with the fourth rule, audit and compliance. Authorities retain the right to conduct forensic, post-filing verifications of submitted numbers. Any discrepancy, underreporting, or simple clerical error triggers the fifth rule, penalties, which include significant financial charges and potential legal action. These 5 pillars create an environment where a company's financial stability depends on the rigorous accuracy of its own internal data. Managing these requirements involves a continuous 6-step life cycle. The process begins with record keeping. Maintaining accurate accounting records and invoices is a mandatory 365-day statutory obligation. In Step 2, the finance team translates raw net profit into tax-compliant figures by adding back non-deductible expenses and applying permitted deductions. This calculation defines the statutory income, the final figure used to compute the tax bill. Step 3 applies current tax rates and capital allowances to that statutory income to arrive at the final tax liability. These 3 steps happen entirely within the company. The tax authority has no visibility into the data or the logic until the return is filed. Because of this, any data entry error in these invisible steps will propagate through the entire calculation, resulting in an inaccurate final tax liability. Once the internal calculations are complete, the life cycle moves to the outward-phasing phase. Step 4 is preparing the return. Official schedules must be completed with accurate disclosures representing the company's legal position. Step 5 is file and pay. Submission of the return and full remittance of the tax balance must occur simultaneously. Statutory deadlines are absolute. Missing a filing by even a single day immediately triggers automatic penalties and compounding interest. Clearing the deadline leads to Step 6, post-filing. Submitting the payment does not close the compliance window. Corporations must retain perfect documentation for 5 to 7 years to answer audit queries from the state. The life cycle is a permanent loop. As 1 year is filed, its multi-year defense period begins, while the next year's record-keeping is already underway. We must evaluate why both the state and the corporation utilize this high-stakes framework. SAS provides operational control and financial predictability, allowing corporations to manage calculation timelines and model cash flow. These benefits pair with strict obligations. The company assumes full responsibility for interpreting complex tax legislation, managing deadlines, and maintaining audit-ready infrastructure. It is a carefully engineered trade-off between corporate freedom and state enforcement. The state reduces its administrative overhead by delegating the calculation to the corporation, while retaining the power to penalize any errors discovered later. For finance leaders, operating within this system requires specific, actionable strategies. Defending an audit requires justifying the underlying data architecture with the same rigor as the final figures reported to the state. This requires 3 actions. First, review workflows to ensure data is captured accurately. Second, conduct a compliance check to detect discrepancies before the tax authority does. Third, engage advisors to secure external validation of internal logic for complex changes. SaaS allows corporations the autonomy to move capital at the speed of modern business, but it attaches a permanent legal tether to every transaction. In this landscape, meticulous internal data architecture is the only reliable shield against significant legal and financial exposure.